manufacturing overhead and credit accumulated depreciation. And then they apply the manufacturing overhead, and they applied it at $6 per machine hour, and there's 15,000 machine hours. So the allocation base was machine hours. The predetermined overhead rate was $6 per machine hour. And how did we get that? We estimated the total manufacturing overhead cost and divided it by the total estimated machine hours that was supposed to be worked. And we came up with $6 per hour. We calculate that predetermined overhead rate before the accounting period starts. We estimate it. And then we apply it as we are building the product. So we debit work in process. Again, there's 3 times that you debit work in process. You debit work in process for actual direct materials, for actual direct labor, but we also debit it for the applied manufacturing overhead. That's something that you should star, because that's, people make that mistake. You debit work in process for the applied manufacturing overhead, and then you credit the account manufacturing overhead for the applied amount. With the actual manufacturing overhead, we've been debiting that account, but the applied amount, we credit that account. All right. Does that seem a little bit difficult to absorb? Well, here, let me show you this. This was the example I showed in class. Do you remember that? Manufacturing overhead, 91,000 was the actual cost. The applied amount was 87. So the 87,000 is on the credit side, isn't it? The 91,000 is on the debit side. The difference is, what's the difference? Is it $4,000? Okay, let me show what happens when you have that. It's going to be, which side's going to be larger? The debit side's larger, isn't it? So we have a debit balance of 4,000. Well, because the manufacturing overhead is a temporary account or a clearing account, we have to get that to 0. So it's easy to get that to 0. We know we would have to credit the account, manufacturing overhead, to get that account balance to 0 now, right? So you see that? To adjust the account, to clear out the account, we had to credit it. And if you turn to page 116, in the middle of that page, they have manufacturing overhead, a clearing account. You see? Actual overhead are charged to this account as they are incurred throughout the period. When they say the actual overhead costs are charged, that means they debited the manufacturing overhead account. And then on the credit side, overhead is applied to work in process. So we debit work in process and we credit manufacturing overhead. So those are kind of, now staying on page 116, you see that they applied the overhead, $6 per machine hours times 15,000 machine hours, $90,000 we debited to work in process, but then we also credited manufacturing overhead. Okay. And then do you see on that manufacturing overhead account, our total credits is 90,000. Our total debits are 95,000. So we have a $5,000 debit balance. We didn't apply enough. The actual was 95. We only applied 90. So we have to close out the manufacturing overhead account. We're going to debit cost of goods sold. We're going to increase the expense account because we didn't apply as much as the actual overhead was. And now at the end of the accounting period, we know what the actual numbers are. So we make the adjustment at the end. So to close out the manufacturing overhead account, we would have to credit that account 5,000, and we debit cost of goods sold. And that might take more than once hearing it or seeing it, Especially if you do the homework, you'll do better with it. And then on page 119, they're just putting all the journal entries in. In 12, they're showing the last entry. You showed this how much you made in sales. You didn't get cash. You debited accounts receivable, credited sales, and then you match the cost of goods sold. The cost of goods sold will be the goods we had in the beginning, finished goods, plus the cost manufactured this time period. That's the total we could have sold. But if we have an ending finished goods, we got to subtract that to get our cost of goods sold number. So anyway, I hope that helps. And on page 121, they have an example of the cost of goods manufactured and cost of goods sold. You see that? And that's probably the example that you use when you do your homework problem. And that's the format that you'll memorize. And if you practice it enough times, it'll be easy for you. And then the cost of goods sold goes on page 123, goes on an income statement. Goes on an income statement. Because on page 121, they had an adjusted cost of goods sold of $123,500. They put that into the income statement. They take their sales less cost of goods sold of $123,500. You get your gross margin, then your selling administrative expenses, and you get your net operating income. And then on page 123, they talk about the difference between the overhead cost applied to work in process and the actual overhead costs for the period. We either under or over apply the overhead. It's simple. The right side of manufacturing overhead account, that's the applied side. The debit side, that's the actual. So if the applied is less than the actual, we under applied. If the applied amount is greater than the actual, we over apply. So, yeah, so then the very last thing is comparing the two methods of disposing of under or over applied overhead. On page 127, in the middle of the page, instead of just closing it out to cost of goods sold, they close a portion to work in process, to finished goods and cost of goods sold. Why is that? Well, the reason they do that is, let me see if this page here, the reason they do that, I've got to get a scrap sheet of paper. Since I don't have my dock camera, I'll have to show you. So in the manufacturing of the product, these three accounts are involved here. The first place, can you see that? Or okay, right. So now I'm going to put this in. I'm going to put direct material costs at actual. I'm just going to make up numbers here. Let's say that was $10,000. And then direct labor costs, and those are actual. Let's say those are $30,000. Okay, do you see that or not? Yep, and they're debited to work in process, right? That's the rule. And then we have manufacturing overhead, and we're going to apply that amount. And let's say it's $20,000. Can you see that, or is it too small? 20,000. And I just made those accounts up. I mean the amounts up. But we always put in the direct material cost at actual and the direct labor cost at actual. But to work in process, we have to apply the manufacturing overhead, right? And then I'm going to show manufacturing overhead account over here. So manufacturing overhead is a clearing account. Does it show up on your screen? Okay. So if we debited work in process from 20,000, we have to credit manufacturing overhead for the applied amount, because on the debit side, we're debiting actual amounts. So you see the 20,000 to work in process, that's the applied overhead. We debit that account and we credit manufacturing overhead. Now, I'm not showing all the actual amounts, but you would have the actual, you'd be debiting those, and you're going to compare the actual with the applied amount, right? No, it's not. I just put X's. I just put X's. Do you see that now? Okay, so I'm just showing that that's what you do. You would put actual numbers down, but I'm not making up any, but it doesn't really matter. I'm just trying to show you the flow. So the first time we put overhead into production, we put it into the account work in process, right? Now, when we complete these goods, let's say that totals a total of $60,000, but we only transfer out, say, $35,000 out. If we transfer 35,000 out, then we have 25,000 still in the work in process inventory. So do you see that? We completed, can you see the 35,000? So it's no longer in work in process. It got put into finished goods inventory. So do you see the debit to finished goods and you see the credit to work in process? Those costs are no longer being worked on. Those costs are now in a finished good sitting, waiting to be sold. Can you see it? Like, okay. So then now we sell some of the goods. If we sell it, we debit, let's say we sell $30,000 worth. So what would we have to do if we sell 30,000? Well, that 30,000 would no longer be in the finished goods inventory, would it? It becomes an expense and cost of goods sold. Do you follow that? So do you see the cost first come into work in process? We have three costs: the actual direct materials, the actual direct labor, and the applied overhead. Once products are fully completed, they no longer belong in the work in process inventory. We got to transfer them to finished goods. So is this the debit to finished goods and the credit to work in process? We take it out of the work in process account. Now it's into the finished goods account. When we sell it, we take it out of finished goods and we make it an expense. So did you follow the costs flowing through the system? Okay, so now what do we have here for ending work in process? Ending finished goods. And then our ending balance for cost of goods sold. So let me show you, see if you understand. Can you see that? That's what's left. We didn't sell $5,000 worth of goods. How about the work in process, the goods that were partially completed? How much costs are in the partially completed work in process inventory account? Yes, and how much in the finished goods? And how much did we sell? Okay, tell me what was the total amount of applied manufacturing overhead that we put into work in process? Is that 20,000 there? Okay. Well, at the end, when you add up all of this, does that give us 60,000? Well, of the 60,000, 35,000 got finished and got transferred to finished goods. What was left is 25,000. Of this 25,000, some of it is direct materials, some of it's direct labor, and some of it is the applied overhead, right? And so these costs, direct materials, direct labor, and the applied overhead, 35,000 got transferred to finished goods inventory. Of those, we sold 30,000. So that means 5,000 includes a little bit of this applied manufacturing overhead, right? And what's in 30,000, some of there's three costs in that 30,000. Some of this direct material, some of this direct labor, and some of this applied overhead. So this is the ending balances of those accounts at the end of the accounting period. We had $25,000 worth of costs still in work in process. We had $5,000 of those costs still in finished goods. And we sold $30,000 of those costs. So in work in process, finished goods, and cost of goods sold, we have a little bit of direct materials, a little bit of direct labor, and a little bit of applied overhead in all three at the end. So the harder method is to allocate a portion of the under or over applied overhead to these three accounts. So let's look on page 127. Can you open your book to 127? Now, I'm going to use their numbers, okay? So let's go through the steps. I think near the top of page 127, step 1 of exhibit 311. So 311 is kind of confusing. At the very top, they show manufacturing overhead applied to production. There's a total of 90,000. It's applied to two different jobs, to job A and to job B. So they applied 60,000 to job A, 30,000 to job B. Are you following exhibit 3-11 so far with me? Well, let me start over. Tell me when you're at that exhibit 3-11. The first box, they show manufacturing overhead applied to production, 90,000. Do you see that or not? Okay, this is on page 126. That's why I like a real regular book. I can flip through the pages pretty easily. Okay, so you see at the top box, the total manufacturing overhead applied to all the jobs is 90,000. There's only two jobs. One job got applied 60,000, the other job 30,000. Okay, of the 60,000 that was applied to job A, some of the goods are in the finished goods inventory. Some of those goods got sold. Job B, the 30,000, is still being worked on. It stayed behind in ending work in process. And so look what they did. They came up with percentages. So they had an ending work in process of 30,000. They had an ending cost of goods sold of 45,000, and they had finished goods of 15. Add those three numbers up. 15,000 plus 45,000, that gives me 60,000. I add it to 90,000. The denominator becomes $90,000. You're going to take the amount of finished goods. We have 15,000. We're going to divide 90,000 by 15,000. That gives us a percent of 16.67%. We do the same thing for cost of goods sold. The total is 45,000 divided by the total of 90,000. That's 50%. The work in process, we got 30,000 divided by 90. That's 33.33%. So of the total applied overhead that are in the three inventory accounts, well, actually, two of them are inventory accounts, work in process, cost of goods sold. Finished goods is an expense account. So those three accounts is where some of that total 90,000 overhead is sitting, right? So that means so this method says we're going to adjust these three accounts. So if we over applied it, we got to subtract it. If we didn't apply enough, we under applied, and that's what they did. They didn't apply enough. So they take the amount that was under applied, it was $5,000. So we applied say 90,000, and the actual is 95. So we underapplied. So we got to take the 5,000 and multiply it by the percentage. That's how much finished goods. If you multiply it by 16.67%, 5,000 times that, that's $833.50. You're going to have to increase our finished goods inventory. We're going to have to increase cost of goods sold 50% of the 5,000 or $2,500, and then the work in process account will get 1/3 or $1,666.50. Now, 2/3 of the way down on page 127. Tell me when you're on page 127. Do you see the $1,666.50, the debit work in process? And you see the finished goods, $833.50 debited to finished goods, and cost of goods sold is $2,500. And then you have to credit manufacturing overhead because they only applied 90,000. The debit side, the actual is 95,000. So we had to close out manufacturing overhead. We had to zero that account out, and we had to allocate the underapplied overhead to 3 accounts. So if you go back to page 126, you'll see those 3 numbers that got put into the journal entry on page 127. So that's a little bit harder to do, but I hope you can follow that example now, or are you a little bit lost on it? Okay, so what they're saying is not all of the applied overhead is sitting in finished goods inventory, or not all of it's in cost of goods sold. It's in all 3 accounts. And so we're going to get a percentage based on the ending balance of those 3 accounts. So that's, and then there's the journal entry on page 127, instead of just simply debiting cost of goods sold and crediting manufacturing overhead. So there you have it. That's pretty much it. Well, what would be different is instead of debiting work in process, finished goods, and cost of goods sold, we would debit manufacturing overhead and we would credit work in process, finished goods, and cost of goods sold. If we applied too much, let's say they applied 100,000 and the actual cost is 95. So now the manufacturing overhead account has a credit balance of 5,000. To close that account out, you would have to debit that account, and you'd have to credit work in process, finished goods, cost of goods sold, because you applied too much. Actual was less, so you got to reduce your amounts there in those 3 accounts. You allocate. Yes. Yeah. All right, Sheree. I'm hoping that this helped you a lot. And then go ahead and do the homework. And you got those other exercises you can look at to see if you find them helpful. But the first 2 should be really helpful.